The closing bell rang just about 15 minutes ago on this Tuesday, June 2, 2026. So let's get right to the scoreboard.
Let's hear it.
If you're just looking at the closing print, it looks incredibly pristine. The S&P 500 closed up a fraction of a percent to hit 7,608.50 day. The Nasdaq held essentially flat at 27,095.92. And the Dow surged another 150 points, pushing past 51,200.
Right. So on paper, it's this serene, record-breaking tape.
Exactly. But our mission in this deep dive is to look at the actual institutional strategy briefings from bulls, bears, and the bell, because they're painting a completely different picture.
Yeah, that surface-level narrative is a complete illusion today. I mean, if you look under the hood, this session was an absolute choppy mess.
So not a breakout.
Not even close. It was a massive head fake. What we saw heading into the close was just a violent tug-of-war. If you're trading off those headline index numbers right now, you are flying completely blind into a storm.
Which is wild, considering we're hovering at all-time highs.
Yeah.
So let's talk about the narrative. What is actually driving this chop?
It's all about extreme AI bifurcation. Capital isn't rising together right now. It's violently splitting. You have institutional money completely dumping their software positions so they can indiscriminately chase breakouts in hardware.
Right, the classic pick and shovel boom. I mean, look at the sheer volume on the winners today. Marvell Technology, ticker MRVL, exploded nearly 30% today.
Unbelievable move.
And it closed around 284.90. The catalyst wasn't even an earnings beat, right? It was just Nvidia CEO Jensen Huang at a conference openly calling Marvell the next trillion-dollar company.
Which just triggered an instantaneous scramble. And it wasn't just Marvell. Look at Hewlett-Packard Enterprise, HPE.
Oh, wow, yeah. Up over 16% on the day.
Right, and they were up over 25% at one point intraday. They had this massive AI-fueled earnings beat. And the demand for their servers is so heavy they pulled their 2028 financial targets forward by 2 full years.
That is insane conviction from the buyers. But like you said, they had to fund those purchases somehow.
Exactly. And the funding came straight from a software bloodbath. I mean, look at Salesforce, CRM. Just yesterday, it was the biggest winner on the board.
And today, they completely reversed course. CRM tumbled 5.67%.
Total fade. They just dumped it. Other major names, too, Atlassian, ServiceNow, they were all just aggressively sold off.
It's like we're in this 21st century gold rush, right? Everyone is frantically dumping the gold miners, the software companies, and throwing all their cash at the companies selling the pickaxes and shovels.
That's a perfect analogy. The market is looking at enterprise software and wondering if an AI agent is just going to replace their entire business model in 3 years.
But wait, I have to push back on that. Is it really normal for smart money to just abandon highly profitable software companies in a single day just to chase a semiconductor breakout off a quote from Jensen Huang?
In a normal flush market, no.
Yeah.
But we are incredibly liquidity constrained right now. Smart money isn't just abandoning risk. They're drastically narrowing their exposure.
Because they only have so much capital to deploy.
Right. They know the physical AI infrastructure has to be built first, regardless of which software wins. So they cram everything into high-conviction hardware.
Which brings us to the $80 billion elephant in the room today. If everyone is desperate for capital to fund this hardware build-out, we have to talk about Google's parent company.
Alphabet. Yeah, this is the shocker of the session.
Alphabet, ticker GOOGL, announced a record-breaking $80 billion equity offering. And the briefing makes it very clear this is explicitly to fund their massive AI CapEx build-out.
Which is exactly why the stock dropped over 2% today. It dragged the whole communication services sector down with it.
But wait, let's unpack this. Alphabet is arguably the greatest cash flow machine in capitalist history. If even they have to hold a massive bake sale and dilute their own shareholders just to afford these AI servers.
What does it say about everyone else?
Exactly. What does that say about the rest of the corporate world trying to compete?
It says the macroeconomic divergence is severe right now. AI CapEx is completely outpacing corporate cash flow. The hyperscalers can't even fund this purely from their own operations anymore.
Even with Warren Buffett's Berkshire Hathaway reportedly snapping up $10 billion of the deal today, the sheer scale of that dilution really spooked the street.
Because an $80 billion equity offering is highly dilutive. It literally sucks massive liquidity out of the broader market.
Right, because giant index funds have to rebalance. They have to sell other stocks to free up cash to buy the new Alphabet shares.
Exactly, which sets up our next major issue perfectly. If capital is being drained by Alphabet, and everyone is dumping software to buy Marvell, what's happening to the rest of the market?
The briefing calls it the breadth mirage.
And it is terrifying if you look closely.
So let's look at the internals. The S&P 500 just logged its ninth consecutive daily gain.
9 days. But for 6 straight sessions now, more stocks have actually fallen than risen on the NYSE.
Wow. 6 days of negative breath while the index goes up.
Right. And if you pull the data, going back to 1996, the S&P 500 has never risen for 6 straight days with negative breath. Never.
Wait, really? What was the previous record?
Only 3 days. We are doubling a historic anomaly right now.
Because it's a market cap weighted index, right? So
Yeah.
3 or 4 giant tech stocks are literally dragging the entire S&P higher while everything else drowns.
Yes. Traditional economic bellwethers, JP Morgan, Procter & Gamble, Nike, they're all dragging lower.
And the institutional briefing also noted that volume into the close today was incredibly muted. It was well below the 30-day average.
Which tells you the real money, the institutional pension funds, they did not buy this closing print.
No volume confirmation at all, which perfectly explains this weird metric I saw. Usually, a 9-day winning streak absolutely crushes volatility. People get complacent.
But the VIX refused to drop.
Exactly. The VIX actually ticked up today. It closed at 16.15.
Right, because option desks are actively pricing in massive macro friction. They see the overheat.
And speaking of overheat, let's look at the macro data from today. April JOLTS job openings surged way past expectations.
Huge miss to the upside. 7.618 million open jobs versus the 6.88 million expected.
Which means the labor market is still running hot. Plus, corporate margins are high, right? Q1 EPS was up 29%.
Which completely locks the Fed in a cage. It locks in a higher for longer rate regime. They can't cut rates with data like that.
And that's why the 10-year yield is just screaming right now at 4.43%.
Exactly. You have a risk-free yield at 4.43%, but at the same time, equities are trading at historic dot-com era valuations.
Yeah, the Schiller PE is sitting at 42.78 right now. That is priced for absolute perfection.
And the macro environment is far from perfect. I mean, look at the geopolitical flares.
Right. Despite those ceasefire signals floating around on Truth Social over the weekend, the persistent strikes between Israel and Lebanon are keeping oil prices hot.
Brent crude is elevated near $93.78.
Which just maintains this incredibly sticky war premium on energy, feeding right back into the inflation loop.
Right. So to visualize this whole setup,
it's like a sports team that keeps miraculously winning games, but their star player is scoring 100% of the points, the rest of the team is injured on the bench, and the stadium is slowly catching fire.
that is exactly it. It looks great on the scoreboard, but you wouldn't bet your life savings on them winning the next game.
So if the foundation is this fragile, but the AI momentum is just undeniable, how is institutional strategy navigating this for tomorrow's open? We need the tactical playbook.
It all comes down to the options market mechanics. The strategy desks are laser-focused on a massive gamma wall sitting at 7,600 on the S&P 500.
And we closed at 7,608.50, so we are practically sitting right on top of it. What's the key support level below that?
Support sits at 7,590. Resistance is at 7,650, but 7,590 is the critical line in the sand.
Because if 7,590 fails, what happens?
If it breaks, option dealers are forced to aggressively hedge. They will dump index futures, which basically opens a trapdoor straight down to 7,550.
The forced selling loop. Wow. But the briefing also says, do not fight the macro tape entirely.
Right, because historically, when the S&P logs a 2-month gain of 16% like we just did, it has a 100% historical win rate of being higher 6 months later.
100% win rate. So you don't want to just blindly short this market.
Absolutely not. You don't fight the tape, but you don't buy the broad index either. You trade the specific day 2 momentum plays.
Okay, let's run through those. The institutional sources recommended 2 day 2 plays for tomorrow's open. The first is Marvell.
MRVL.
All right.
They're targeting the $300 level tomorrow.
But they said to cut the cord quickly if it fails, right? Strict stop if it drops below $267.
Exactly. High conviction, but tight leash. The second play is HPE.
Playing that massive earnings beat, the desks are looking to buy a high-volume consolidation breakout right at the $53 level.
With a target of $60. But again, you have to play defense. Keep a strict stop at $51.50.
Because all this positioning, it's really just set up for the main event tomorrow afternoon, isn't it?
Broadcom's earnings.
Yes.
It's highly anticipated.
It's going to be the ultimate test of whether this semiconductor momentum can actually carry the entire heavy market on its back.
If Broadcom misses, or their guidance is soft, that 7,590 support level is going to be severely tested.
Well, let's quickly recap what we've covered today for the listener. The market is severely bifurcated. We have headline index records completely masking a historical breadth divergence.
A very dangerous breath mirage.
We have a relentless AI hardware boom that's cannibalizing software stocks. And we have massive liquidity drains via Alphabet's $80 billion offering.
Right. The lesson here for anyone managing a portfolio is do not mistake index momentum for structural market health.
You have to look under the hood. You have to be hyper-selective in a bimodal market.
Exactly. Don't just blindly buy the index and assume you're safe.
And I think that leaves us with a really fascinating, lingering question to mull over tonight. We are watching the most profitable tech giants on Earth dilute their own shares by tens of billions of dollars just to afford the physical infrastructure of the AI revolution.
The physical data centers, the servers.
Yeah. Right. But if this hyper-expensive hardware phase outpaces the actual software application, the applications that are currently getting aggressively sold off by institutions, who is going to be left holding the bag when the bill for these trillion-dollar server farms finally comes due?
That is the ultimate question. If the software isn't there to monetize the hardware, the whole cycle breaks.
Exactly. Something to definitely think about before the opening bell tomorrow. Keep an eye on those gamma levels, and we will catch you on the next deep dive.